waves of the current economy. First of all, thank you very much for coming. I've got actually quite a few more doctors registered. Yes, actually I organized this for the Medical Association, but Stuart will be doing another seminar about exotic investments shortly. Therefore, he would like to join us today. So hopefully there will be a few more doctors coming in a minute. And so if you want to have more sandwich or coffee, just let us know. Otherwise, I'll just start right now. My name is Jenny, and I work for ING, as you get my card. Many people think that property is the best investment in Hong Kong or just anywhere, anytime. Is it the truth? Property cycle in Hong Kong. From 1997 to 2013, it took us 15 years to complete the whole cycle. From 1997 to 2003, it took us the peak from 97, 6 years down to the bottom at 0.3. And after SARS, what happened? It took us 9 years to get back to where we were. 3 precious opportunities. What does Richard Branson say? Business opportunities are like buses. There's always another one coming. Had you missed the previous bus? There's always another one. So the best chance, looking back, market had dropped 70% and bottomed out during SARS at 2003. Did you buy? Second chance, market had dropped over 30% after Lehman went down in 2009. Did you buy? Third chance, market had dropped over 20% after the new government policies only last year. Did you buy? Had you missed all the chances, today, would you still buy property when the price is over the top? So when is our next bus? What kind of challenges are we facing today? As you can see from this chart, Hong Kong homes are the least affordable in the world. Yes, we are living in the most expensive city in the world, or one of the top most expensive cities. However, due to the short-term or the low interest rates in the past few years, we have this short-term illusion that Hong Kong is very affordable. But when interest rates go up, payments for our mortgage will also go up. And what am I trying to say here? There is unpredictable rising costs and low liquidity. So what are the factors affecting property price in Hong Kong? Hong Kong government policies, new Chinese government policies, US interest rate, bank policies, and rental yield. In order to suppress the overheating property market in Hong Kong, our government had increased land supply and increased stamp duty for non-Hong Kong residents and company buyers. And in order for the Chinese government to suppress its overheating economy, they have tightened credit and more control on liquidity. And since our interest rate is parallel to the US, when US interest rate goes up, Hong Kong low interest rate may come to an end. And what does bank do? Bank has already increased our down payment ratio, and it has also increased interest rate. But the worst part is that they have tightened credit, meaning if you had tried to apply for a loan recently, you would know that it's much more difficult to get a loan today. And the last factor is rental yield. You will be surprised if you actually make a comparison to all the major cities in the world. Let's say, Australia, you might get 6 or 7% for rental yield. And in Hong Kong, we are talking about 2 to 3% only. So it is very low. Now, what is the driving force behind it? Why is the market still going up? Because of capital gain. We've got almost 25% per year in the past 4 years. But where is it going next? Property trend 2013. As a result of what we discussed, there's a decreased speculators from China and overseas. And there's a decreased local buyers or speculators in Hong Kong. And there's also a decreasing price. Recently, if you have been following the market, you will know that it has gone down about 10 to 20%. And I say that there's more pressure for property price to come down in the near future. So what is our option? Let's look at the past 20 years. Who do you think is the winner? Hong Kong stock market, US stock market, or the Hong Kong property market? Anyone wants to take a wild guess?
I would say 3, Hong Kong property market.
And what about you, Sally?
Yes.
And what about you, Stuart?
Yeah, it's a Hong Kong property market.
All right, let's look at the answer right here. Now, there are 4 lines here, each representing a different index. Blue is Midland Property Price Index. That's the property price in Hong Kong. Green is Hong Kong Inflation Index. Red is Hong Kong Hang Seng Index. Purple is S&P 500. So clearly, you can see that the purple line, which is the US stock market, is the winner. And we're looking back from 1995. Does that surprise you or what? And among the 3, who is the loser? It's the Hong Kong property. It is the blue line. I am sure people will be really amazed, and even myself. And what is that? People are still rushing and talking about this unbeatable, this unsurpassable, unstoppable growth in Hong Kong's property market. It all comes back to leverage, because you can borrow money. Whenever you buy property here, you put down 10%, 30%, 40%, 50%, and then what do? You borrow from the bank. So instead of an asset, if you are not renting it out, you have actually incurred a loan, a liability. It is not on your asset column, it is on your liability. However, if you can cover it monthly, there's no problem about doing that either. But if you can stay long-term in the market, actually, the Hong Kong stock market or the US stock market gives you a better return over the long run. And most of the time, you can see that the Hong Kong and the US stock market moves in very similar direction. They are almost in sync with each other. And I'm sure that people who would follow the US market in the evening, at night, stay until 3 a.m., and then they can actually do some trading in the morning and make some money in the Hong Kong market. The reason is because we move in a very similar movement. However, Hong Kong property market has its own life now, a very different movement. It does not have to parallel to the Hong Kong market. Now, but the good news here is that, you see, it doesn't matter where you invest. So long you stay invested, you already beat inflation. Why is that? Because the green line is inflation index. So long you have stayed invested, you're okay. Your money is not eaten up so badly. Now, how would you like to maximize your opportunity and stay on top? Let's do some case studies here. Number 1, invest in property market now. I would say that's a potential loss. Let's say if you have a capital of $4 million, and the property you want to buy is 10 million, which is probably just a decent, nice apartment in the mid-levels. And the loan ratio is 60%, meaning you want to borrow $6 million. And if the property price decreases 20% more, that means it will go down to 8 million in 2 years' time. You would have lost 2 million plus interest expense. What is that? It is 50% of your capital. 50%. Case number 2, invest in the financial market now. I would say that's a potential gain and an increased purchasing power. Why is that? Let's say you have the same capital of $4 million and you put it into a financial asset that gives you a 15% annualized return. So 2 years later, you would have a net gain of 1.2 million. So your capital would have been increased to 5.2 million. And I know for sure the next question is, where do I find that kind of asset? What exactly are you referring to? So I have picked a very big name here and a very successful fund manager just for the sake of this seminar. Templeton Global Total Return Fund, which is a bond fund that's focused on international bonds. Let's take a look here. So apparently you can see that, doesn't work on the TV screen. Apparently you can see that the blue line outperformed the red line by far in the past 5 years. The blue line being Templeton Global Total Return Fund, and the red is the benchmark. So if you look at the year-to-date performance, it has generated 4.9 versus negative 1.4 in the benchmark. If you look at 6 months, it has generated 7.5 versus 1.8. 1 year, 21.2 versus 5.8. 3 years, 39.5 versus 16. 5 years, 77.4 versus 5.2. What does that tell you? It tells you that even if you pick a safer asset class, meaning bonds, and you pick something over, let's say, 5 years, if you have that kind of time, it is actually doable for you to achieve that kind of return. Now, of course, nothing goes up in a straight line. There is sometimes that it comes down, and I would say that short-term volatility. So it tells you that it doesn't matter what you put your money into, even within one bond like this, the fund manager helps you to diversify. So diversification helps you to generate a better return and less risk over the long run. Back to the property market. Let's say if you have already generated that kind of profit and had you waited 2 years, and assuming the market comes more down, so your $5.2 million actually can get you one more property. And how is that? Because if you actually borrow 60%, so 8 million, you actually minus 4.8, you have $3.2 million as your down payment. So if you have increased your capital to 5.2, you get $2 more million in your pocket. So most likely you can buy one more flat. Now what does this case studies tell you? If you actually take the time to do some research and rationalize the whole market, and maybe with a bit of luck, instead of losing 20%, you might actually buy, instead of one flat, buy 2 flats. So that's some luck, some studies, some research, and also a combination of all that. Investment tips. I'm sure some of you here would think that I'm going to give you a number like 005 HSBC or 857 Petro China, or maybe you should buy HSBC at, let's say, 78 or Petro China at 14. But that's not the point. The point is, or the truth is, you do not make money when you buy stocks. You only make money when you sell. So me or anyone can easily give you a number and a price to get in. But how often does your trader have the time to really call you, hey, wait, it's like right now, you should sell it right now. You'll capitalize, you'll make a profit. That is a key point in your investments. So if you do not have that kind of luxury, let's say if your husband or your girlfriend is that particular trader, maybe they can give you that kind of attention. But if you're talking to someone who's always on the road, not sitting right in front of the screen with like only 2 or 3 clients to take care of, it is challenging. So what would I suggest? I would give you 3 magic keys today. And what are these keys? They are the rules of thumb. So I'm not talking about short-term trading or short-term speculations here. I'm talking about investment. So we have plans, we have objectives, we have management. It is all about planning and management. Number 1, I'll give you champion trustee. Number 2, diversification. Number 3, style wealth managers. So What is the power of a champion trustee? What am I talking about here? Now, whether you're working for a clinic, a hospital, or you own your own clinic, you have to have MPF. That means whether you are an employee or an employer, you have to pay for MPF. So I think this is an example that can fit everyone. As you know, there are different choices in your MPF: low risk, medium risk, high risk. And so for this seminar purpose, I have selected Global Equity Fund, which is the most aggressive one. And there are many, many different managers in the market. You've got HSBC, Bank of China, Prudential, and obviously ING. And you may not actually realize that different fund managers can create a huge difference even if you pick the same category. Let's look at it here. If you have put in only $2,000 a month and say, you're young and you're just starting, you have 35 years down the road, then when you retire, had you selected Fund G, this particular manager, you can retire with 3.2 million versus 3.2 million less. So as small as $2,000 compounding over a long term actually can make a huge difference. Have you managed it, let's say, professionally? So in order to give you a more comprehensive picture, I have put these comparisons together. This is my favorite chart in this presentation. As you can see, there are different colors here: yellow, green, and red. So there are three main asset classes in our MPF: low risk, guaranteed; medium risk, let's say mixed asset; and high risk, let's say global equity. So you can see that obviously your risk and return is kind of proportional. So if you have time and you are aggressive, you want the highest return, you might want to take global equity. But even within that class, you can see that they have very different performance. And if you are closer to retirement and you want safety, you don't want to take any risk, please, by all means, choose guarantee. So if you choose guarantee fund, you can see that they actually have a huge difference. We're talking about 7 times here. But if that's your objective, to sleep at night safely and peacefully, you don't want to worry about anything, do not go for the highest return, go for the lowest risk. And even within that same category, guarantee fund, you can see that different fund managers also give you quite a different return. Say, if you have a capital of 840,000, if you pick the most aggressive and the most successful manager, you can retire with 6.5. And if you are happy with low risk, low return, you get about $1 million. It is a huge difference, but also you know that there's a lot of changes and a lot of things can happen over the long run. So the good news is you can always change and switch in your portfolio. Same in MPF, same in your private portfolio. That's why you need to talk to some professionals to help you all the way with our changing lives and our changing objectives. Now I know the next question would be, so who are these fund managers? What is A, B, C, D, E, F, and G? Now we cannot disclose it here in the seminar, but afterwards, in our private meetings, we can totally share with you those information. All right, let's look at the second key, diversification. It's interesting how you practice it every day without even knowing it. But when I say that, how many of you here has only one bank account? Unlikely, right? I'm sure you will have, let's say, HSBC and let's say Bank of China or Citibank. Why? Because you want to diversify your risk and also for convenience purpose. And see how it applies to our financial market. If you take a look in the past 10 years of S&P 500, you can see that different sectors has very different returns. Financial, energy, healthcare, IT, you name it. The news is that none of the same color stay on the same position in the past 10 years. What does that tell you? That means when one is making the most return, the other one can be losing all your money. So you want to have a combination and you want to diversify it. Let's look at the next page. In order to track the performance and show you how different they actually can deviate from each other, I have decided to choose two sectors, consumer discretionary and energy. So you can see that when one sector is at the peak, the other one is at the bottom, and vice versa. There are times that they are moving in parallel, there are times that they're completely opposite. So in that case, again, it tells you to diversify.
What's consumer discretionary?
Well, it's like all sorts of consumer staples. And let's say 10-year snapshots of asset class. How does it work in different asset class? It's the same. You cannot find the same color continuously in the past 10 years. However, you would say that, well, but Jenny, I see the green at the bottom all the time. What is that? See, it's very easy to be the worst performer. It's just hard to stay on top. So, fixed income. If you're happy with low risk and you want a peace of mind, by all means choose fixed income, because if that's what you want, it's totally fine. It gives you the lowest return, but when the market is very unstable, let's say year 2011, when we have the euro crisis and we have the credit crisis and all that, it actually gives you the highest return. Fixed income, 7.84. So again, it tells you it is important that you have a portfolio of different asset class or different sectors, and you should have, someone to help you to monitor it. And at times you might want to switch, at times you might want to profit lock in, at times you might want to take some money out. That is the message. So diversification maximizes your potential gain and minimizes your loss over the long run. Star wealth managers, obviously I have a team of managers here. Whether they are star or not, you gotta tell me. How would I choose wealth managers? I'm sure this industry are filled with people like ourselves, from your family, your co-worker, your friends, your neighbors. There are many people in this industry, and everyone who is licensed can give you some kind of advice. But who would you choose? I would go by these qualities: credibility, expertise, strong company support, experience, and professionalism. It's very easy to find one or two factors from almost any manager who is licensed, qualified out there. But to put all these 5 together, sometimes it's a bit of luck as well, and whether you can get along on 2, that's a very important factor too. Professional wealth management, what do I mean by that? We'll look at 2 different portfolios here. One is a typical Hong Kong investor, one is a typical international investor. So you can see that Hong Kong people love property. People love to put their money in this particular sector no matter what. And I like it too, there's nothing wrong with that. But you can see at least 70% of their money is in the property market. There's a typo here, sorry. And 10% is in China and Hong Kong stocks. Another 10% is in cash. Now interestingly, 10% or increasingly people are putting their money into others. And others, what do I mean? I actually mean something like arts, wine, antiques, or overseas properties. And it's a very big trend right now. Recently, it's very hot in the market. I'm sure you get invitation from London properties, US properties, Mongolia, and so on and so forth. So actually, this others is increasing. And in a typical international portfolio, you can see that it is very different. We are talking about 40% in property, 40% into investments, 10 into cash, and 10 into others. Now, why would I say that? 40% actually would be in bonds, equities, REITs, pension, or ETF. Now, you would say that that's interesting. Why would they only put 40% there? I think it has a lot to do with culture as well, because I think traditionally at, let's say Europe, for example, I've got quite a few European clients telling me that Hong Kong people has a completely different mindset. We like to trade our properties. We like to speculate. It's not a home, you know. And I personally have friends who do that. They live with their spouse for a few years, decorate it, and when the market's good, they sell and they move to another place. So it's a tool to make money. But in, let's say, European countries or even the US, they buy a house, they live there. The speculative aspect is much less. So they would have a more diversified and balanced portfolio in general. They would put some money into bonds and equities and so on and so forth, because most of them have a more comprehensive view. So why do I need a professional wealth management? Again, all of your doctors here. Time is money. Why don't you work hard on making money and let us make your money work even harder for you? Or why don't you save more lives, help more people, and we do the hard job for you? How does it work? In general, there are 3 stages of wealth management. We are talking about creation, preservation, and succession, depending on your age and the stage of life you're at. For example, when you're younger, when you just finished college, you might want to, work hard, take more risk because you have a lot of time. Then you can use systematic investments, which is putting monthly investments or regular investments onto some sort of your own selected assets, or lump sum investments. After a while, 5, 10 years after you start working, you might have already accumulated a lot of cash. And if the timing is right, you want to put it all in at one point, one single entry to maximize your return. I mean, if you pick the right time, that's the lump sum investments. Then as you grow older, and you have already been promoted, you've got a family, you've got kids, they're going to college, you want to be more careful, you want to take less risk. And what do? You want to do preservation. So you don't want to be so aggressive at that time. So maybe you want to change your portfolio. Instead of putting more money into, let's say, stocks, you might want to put more money into bonds so that you would have, let's say, lower risk and still reasonable return. And succession. What do I mean by succession? It's estate planning. Now in Hong Kong, we don't have state duty, but I know in places like the UK or the US, they have very high state duty. That means inheritance tax is something you need to consider. And what do? Mostly, most people would pick large insurance policies. So that's something you can do. You have designated beneficiaries, which is something you can change or not change. As sometimes you might break up with your spouse or your children may disappoint you. So just change the names anytime you want. But obviously, before you say bye-bye. And trust. Trust is something more sophisticated. You can even put your properties and your insurance and your assets overseas, your arts, antiques, anything, everything you can put into a trust account. It costs you a little bit more than buying just an insurance, obviously. But a trust is like a bigger umbrella. So it gives you more protection even from creditors. And so if you do all this, it will give you the maximum tax efficiency and the least chance of dispute. Obviously, we cannot guarantee it, because even if you have a will, people can still have millions of ways to dispute it if they're fighting. So what is my advice for you today? Everyone has a different financial needs and expectations. So we need to understand you well before making any professional recommendations. Again, if you're married, it's very different from if you're single. If you have children, it's very different from if you do not have children. I'm just giving you a very simple example, because the kind of risk tolerance you have is very different at different stages of life. So what would I recommend you? Make a private meeting with us. So we're coming to the end, and I want to say that property is a great investment, and I love it, we love it. There's nothing wrong with it. But at this point, at this particular time, I would think that you should consider many other choices or options rather than just focusing on buying properties in Hong Kong. So what are the other opportunities in addition to our ING platform? I need to give a disclaimer here because from where we are, we focus on insurance and banking products. But because we have to stay competitive, we have to be resourceful today. So we have connections to people or companies, or we can give you our own recommendations outside our own platform. For example, overseas properties, you can see China, UK, US, Australia, Japan, Mongolia, etc. And art, wine, antiques, private equities. So we have that kind of resources and at least some sort of expertise there as well. So that can help you if you want to talk about it. Before we end it, I want to make a quiz you. So this would remind you of my poster. What is the best investments in the past 10 years in Hong Kong?
US stock market.
No, 10 years.
Well, you said in your previous poster is the stock market.
No, that is 20 years.
20 years.
This is 10 years.
Properties, I think.
Okay. What is the worst in the US?
Property.
Very good. So how do you ride the waves and stay on top? Let's see what Warren Buffett said. You only have to do a very few things right in your life, so long you don't do too many things wrong. And what do I say? Stay invested and stay diversified. Thank you very much. This is my biography, and I hope you find it helpful. Enjoy your sandwich and coffee. We're here until 2 o'clock, so any questions, and hope you make a private meetings with us. My name again is Jenny. I'm taking care of corporate accounts, and I'll talk to your medical association again if I get a chance to, and invite you to some other seminars hopefully. I'm doing one for Australian Chamber end of next month. That's for Australians mostly. And then Derek and Rena is my teammate, so they take care of individual accounts. So I'll leave it to you. Talk to them and ask them questions. Thank you very much.